So good afternoon, everyone. My name is Hanspal, and in this session, we're going to talk about one of the most interesting topic which people are talking about in the present time: the impact of the monetary tightening. I just write down the name for the topic today. So here we are discussing about the impact of the monetary tightening. So what exactly do we mean by the term monetary tightening and why it is so important in the present scenario and how this monetary tightening will impact the stock market and ultimately us. So during this COVID-19 pandemic, we have all seen that the market started to crash in the early phase of March 2020. Stock market beat your Sensex, Nifty, and the global markets as well lost more than 60 to 70%, and the market was all down. At that time, in the periods of recessions or in the periods of such calamities as we saw in the COVID-19 pandemic, the central banks of the respective countries start to come up with quantitative easing and they tend to maintain a dovish stand. So there are two things that we're going to talk about. One is dovish and the other is hawkish. So two stands the central banks of the countries can maintain. The one stand is a dovish stand and the second one is the hawkish stand. So what basically happens when these types of situations, for example, a natural calamity or a kind of pandemic like COVID-19 comes into, or some kind of recession, as we saw in the period of 2008 asset bubble crisis, we saw the same prices in the dot-com bubble of 2000. When the prices really come down and the people have no money with them, people lose their jobs like because of these calamities or because of these situations or because of the asset bubble burst or the dot-com bubble burst. There is a huge negative impact upon the society, the general public as well as the employees of the company. Therefore, to tackle these effects, the central banks of the respective countries, what exactly do they do? They tend to reduce the interest rate and they tend to maintain an accommodative stance, which we popularly call as a quantitative easing or the monetary easing. They tend to reduce the interest rates. And why do they tend to reduce the interest rates? Because they want to increase the activities with the business activities or the entrepreneurial activities within the country. Why? Because when the interest rates are low or the repo rate is low, the repo rate is nothing but the rate at which the commercial banks take loan or they take cash from the Reserve Bank of India against a collateral. So the interest rates are reduced. When such interest rates are reduced, so what basically happens, the businesses are induced to take more loans. Because ultimately these businesses require loan for the working capital requirement, for expansions, for diversifications, adding a new product category, adding new product lines. So for all these things, the businesses will be taking loan. And because of these activities, be it a recession or a pandemic, the activities get disrupted. Because ultimately the businesses have lost all their money and they have no money to put in as fresh investment into the purchase of new assets for the working capital requirements or for adding some new product line or diversifications or expansions. So to encourage these businesses as well as the general public, the central bank of the respective countries, be the Reserve Bank of India or the Central Bank of United States or any other central bank of the respective countries will tend to reduce these interest rates. When these interest rates are reduced, people or the businesses will tend to take more loans, and that would encourage the entrepreneurial activity within that particular nation or country. Because now the money is cheap, and the people would be taking more loan or purchasing more loans. And because they want to encourage the business activities, ultimately the government of the respective countries or the central banks of the respective countries, they want to encourage entrepreneurial and business activities so that more people take more loan and these activities are encouraged and we can get out of the phase of recession. Same thing happened in 2000 dot-com bubble. Same thing happened in 2008 asset bubble crisis and the same thing we saw in the COVID-19 pandemic. And this stance we popularly call as a dovish stand because in a dovish stand, the central banks or the government is more focused towards growth and less upon inflation. Because the major drawback of this quantitative easing or this monetary easing is inflation. Because cheap money is available in the market. Right? And there is more supply of money in the market and hence inflation also rises. And what do we mean by inflation? Inflation is nothing but the rise in the price of the commodity, or simply MHAI, the reduction in the purchasing power by the people, because ultimately the commodities, the raw materials, the inputs, whatever they're buying to produce the final goods, whatever the final consumers are also buying from the market, the price of it will rise because ultimately free money is available in the market and there is more supply of money in the market. Because when the central bank triggers to print more money, like no one can stop the central bank and it will keep on triggering that remote and more money will be coming up in the market and more flushing would be done for that money and hence more inflation. And that is a double stand. So if someone asks you that what do you mean by the double stand, or when in the news channels, be it CNBC, TV18 or CNBC, and that the people are talking about that the central banks of that respective countries have still maintained a double stand. So we can see still two countries, two major countries, be it China, Japan, and some other small countries are still maintaining a double stand because they're still focusing towards growth and less upon inflation because these countries have not yet seen much inflation. Almost all the countries are having an inflation of more than 7.2%. US having the highest of around 8.5, 8.4%, though like it came down in the previous month on June data to 8.1%, but still the inflation is very high. Barring Japan, where just like inflation is around 6.9% to 7%, or be it China, because recently China had a quantitative easing process and a crackdown, where all the businesses were melted down, the IT stocks were hit bad, and basically like new kinds of regulations came into place. So the amount of stimulus and quantitative easing was there. In the later point of time, the problem of inflation can also hurt China, but in the present time, the problem of inflation is not hurting China because of that meltdown or the crackdown. So ultimately, China is working quite opposite to the Western world, we can say, right? And the question can arise this time that why Japan is not facing inflation. Japan is not facing inflation because Japan has been a net commodity exporter and not importer. Those countries, especially like India, who are the net importers, they face huge current account deficit, fiscal account deficit, the currency depreciation. They're facing the problem of high prices and they're also facing the problems of high inflation. But Japan being a country who has been over the past many years, Japan has been a country of a net exporter, and that has been the reason why the problem of inflation has not hurt Japan the most. But in the present time, the imports are slightly rising a bit more than exports. But in the longer term period, the Japan has been a net exporter. If the imports continuously still rise as compared to exports, again Japan can also become a country which can become a net importer and further the problem of the currency depreciation and inflation as well. So the major benefit, as I told you, of the quantitative easing or the monetary easing is the business activities are encouraged. The entrepreneurial activities are encouraged because ultimately those loans are available at a cheaper rate. Right? And also the Reserve Bank of India has not increased the reverse repo rate as well. Why? Because the reverse repo rate is the rate at which the commercial banks park their excess money with the central bank, or basically in terms of India, the Reserve Bank of India. Right? So when the reverse repo rate is also low, these commercial banks will be discouraged keeping their excess money with central banks because ultimately the central banks would be giving them too less. So in this case, the commercial banks would not be encouraged to park their excess fund with central banks. And that is why the impact of the reduction in the repo rate and the reverse repo rate has a positive impact upon the businesses and encourage the entrepreneurial activities and helps the economy come out of the phase of recessions or these periods as in the COVID-19 pandemic we also. That is a double stand, but the more focus is towards inflation and less on growth. More on growth and less on inflation, basically, like when we talk about the double stand. The focus is towards growth and less upon inflation. But at a later point of time, the impact of the quantitative easing or the monetary easing tends to reduce and more money comes into the market and there is huge supply of money in the market. Right? But now since there is more supply of money in the market, the problem of inflation comes into place and everything becomes possible. At that time, the focus can shift from growth to inflation because the governments or the central banks of the respective countries they have to tackle inflation and focus like less upon growth, and that's a hawkish stand. So the major difference between the dovish stand and the hawkish stand is a dovish stand comes at the time when there is a kind of recession or some pandemic like COVID, where the central banks have to encourage the business activities or entrepreneurial activities, and they have to help the people come out of the phase of recession. So that's a double stand, but the focus is towards growth and less upon inflation. But when we talk about the hawkish stand, the focus is towards higher inflation and lesser growth because the quantitative easing has led to inflation and there has been more supply of money in the economy. So ultimately the prices have risen and some stance has to be taken or had to be taken by the central bank of the respective countries to increase the rates. As we can see at the present time, as in the day I'm shooting this video, like July 2022, the Reserve Bank of India has already increased the repo rate by 90 basis points, 40 plus 50, two times, and planning to increase more because ultimately the inflation has to be tackled. They have a twin problem. They have a twin problem. They have to increase the repo rate and the reverse repo rate, and also they have to reduce inflation. And both have to work in tandem to each other. But the US government, when they reduced this interest rate, they almost came down to negative or almost like came down to zero. Because there the rates came down to 1%, 2%. But when you have to tackle inflation, the real interest rates must always be positive. And what do we mean by the real interest rates? The real interest rates is nothing but the nominal interest rates minus inflation, you get the real interest rate. So this 4.90% as we can see the repo rate in India or catering to the Indian audience like which I'm talking right now, 4.90%. Inflation currently like is going around 7%. Right? So so when we subtract 4.90 by 7, right? So 2.10% is a negative real interest rate. Ultimately, it means that when they're investing into the government securities or government bonds, maybe, or if we are like investing at the rate of 4.9%, because the government securities now have started to give you the rate of interest of 7%, 6.9%, almost close to the inflation, and then further beat inflation, the repo rate rises. But it basically means that you are in fact losing your money if you are investing your money at 4.90% from the point of view of the banks also because 7% is the inflation, right? So suddenly drastically the home loan rates cannot be increased. Agreed, the home loan rates are linked to the repo rates, but they cannot drastically like increase it to more than the rate of inflation. Because inflation is expected to come down in the coming quarters because of the rising interest rates, stopping of the government buying programs, increasing the reverse repo rate. Your standing deposit facility has come into place where they're giving more rates, more than the repo rate, but lesser than the reverse repo rate. And so all these facilities also have come into place, which are encouraging these kinds of institutions to park in their money. That is something which we must know about. Give me a second. Okay. That thing will be coming in and that will be seeking up the excess liquidity from the market. And when such excess liquidity from the market is sucked up, the business activities can again be hampered. The rates are increased in a tandemonious manner. If the rates are increased in a tandemonious manner, the focus will again shift from inflation to growth because there are recessionary fears. And of course, as I told in my previous sessions also, that people fear recessions. There is no point of fear recession because ultimately the recessions helps you to differentiate between the men and the boys. Because ultimately in a recession should happen. I believe the recession should happen because they tend to tell that stocks are fundamentally strong, both in the quantitative manner as well as a qualitative manner. To completely agree in a phase of recession, all the stocks will be falling or all the stocks will be correcting from their all-time high or any of the points at which they have reached. But the strong companies, the fundamentally strong companies, will react less as compared to the fundamentally weak companies. That is when the recession is evident. It will happen not right now. It can happen any of the times. But if you are holding strong stocks in your portfolio, the companies which are having strong fundamentals, the companies which have good positive free cash flows, good earnings, good management outlook, good EPS, good forward EPS, who are not overvalued in that sense. Even if they're overvalued, they can justify their valuation. People tend to say that always sell the companies which are overvalued. It's always beneficial to sell the companies which are overvalued. That overvaluation is justified because we can talk about Nestle. Nestle started from 5,000, 6,000 rupees. The price of Nestle one time was 19,000 rupees. Now like it has come down to like 16, 17,000 rupees, but we can justify its valuation. It's the most overvalued company within the fast moving consumer goods industry, the FMCG industry. Most overvalued company. but it is able to justify its valuation because it has good cash flow, it has good ROE, ROC. So that justification must be there, like when you're talking about the overvaluation. So the impact of the monetary tightening would be the stock market has already started to correct, as we can see in the present time. Already the stocks have come down because ultimately when the interest rates are released, right? A risk-free rate, ultimately your RF. RF is a risk-free rate. I'll write down this term. Risk-free rate. Yeah, this risk-free rate as we talk about is RF. So this risk-free rate is ultimately the return that you are getting on government securities. But if this return is available to you from a government securities, like a risk-free rate, that is, they are taking a lesser amount of risk, hence a lesser amount of return would be given to you. Because that is a risk-free rate. So if they're going towards a risk-free rate, it is an important component in knowing the cost of capital of the firm. That cost of capital is nothing but the weighted average cost of capital back. I will show you one thing. Loading. When we talk about finance, in finance we talk about the DCF model, the discounted cash flow model. So this is the discounted cash flow model that is here. So what are we doing in this discounted cash flow model or a DCF method, very popular method of the valuation of the company? We're trying to discount the future cash flows at their present value. We're trying to know that what is the present value of the future cash flows. And if we invest this amount into this company, that will be able to generate some profitable returns for us or not. So what are they exactly doing? They are predicting the future cash flows. This year 1 5,000, year 2 6,000, year 3 8,000, year 4 7,000, year 5 4,000 are the future cash flows which have been predicted. So just assume if we are in the year of 2022, year 1 is 2023, then 24, then 25, 26, and 2027. The question arises how to predict these future cash flows. So that can be taught to you from a previous session like valuations, like where I've told how to calculate the future cash flow value by using some specific and very simple formulas by creating a financial model. So we try to refer my sessions with financial modeling and valuation where I've talked about the NPV calculation and increasing value, the discounted cash flow method of valuation. These are the future cash flows. But now we want to know that what is the present value of this cash flow? The value of 5,000. The value is in 2023. What is the value of 5,000 right now? If the value 6,000 is in 2024, what is the value of 6,000 in 2022? Value of 4,000 in 2027, what's the value of it? 2022. So for that, we tend to discount these future cash flows by using a discounting rate, interest factor, or BAC. BAC is nothing but your weighted average cost of capital. I will write down this term BAC. It's nothing but your BAC. So weighted average cost of capital BAC. Okay, so it's nothing but the minimal rate of return which the investors who have invested into this company are expecting. Investors can be equity shareholders, it can be debt holders, or any other short-term investors. But whosoever it is, they want a certain return on their investment. Certain return on budget. So we have assumed this at 8%. And now the question might arise, how to calculate the weighted average cost of capital, which is also called the discounting factor or the interest rate factor. The simple way is I've taught in my sessions with financial modeling and valuation how to calculate that. So you can refer those sessions. So if this 8% has been calculated and the formula is nothing but future value by 1 plus interest rate or 1 plus discounting factor or 1 plus BAC or the weighted average cost of capital, and we get these values. Okay, so basically what are we doing? We discounted the future value 2023 into 2022 and the same thing we did for 2026, 27 and so on. Right. So BAC is ultimately if this rate of interest increases. If the denominator increases, it tends to increase to 9%, 10%, 11%, 12%. This value would come down. Mathematically simple math because ultimately the denominator is increasing and the numerator is same. So the value of the equation or the value of the fraction would be affected in that sense. But if this interest rate or the weighted average cost of capital or the discounting factor as we popularly call it it reduces, again the value will increase because ultimately now the denominator is reducing and the numerator is same. So ultimately the value of the cash flows will increase, right? So there is a inverse relationship between the future value of the cash flows and the discounting factor we can see. So when the risk-free rate tends to rise, when there is when there is quantitative tightening or the monetary tightening, the denominator will increase, and as a result, the present value of the cash flows will come down. And when the present value of the future cash flows will come down, the enterprise will be valued at a lower rate. Because if you want to know the enterprise value, or let's just add all these values, the enterprise value will be 23,992. Budget tend to discount these future values. Investment was 20,000. It's a good return as an NPV. But ultimately, the valuations of the firm will also come down. The present value of the future cash flow will come down. That will hurt the valuations. And that is why we can see why these companies are getting affected the most. Right? These companies are getting affected the most. As we can see in this present time. Right? So these things have to be taken into consideration when we're talking about this DCA. When we're talking about the DCA model, okay, so that is something again which is important when you're talking about these things. So that is why we can say this risk-free rate is an important component in calculating the weighted average cost of capital. And see that is increasing the valuation of the companies are coming down and they're beginning to correct. And that is the major reason why we can the valuations correct and huge correction in the market. So again, since the interest rates are on a rise, so that would be the opposite of the quantitative easing. And now the businesses will find difficult to take more loans for the working capital required, for expansions, for diversifications. But if that hurts the businesses more and stop these expansion activities, I think the focus might shift towards growth and less upon inflation if the recessionary fears are very high.